The following program has been pre-recorded and is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, this is Esther Gulius, the tax lady from EG Tax, and this is Ask the Tax Lady, and several times a year what we do, instead of answering your live phone-in calls, today's one of those email days, so don't call, save till next week, but of course you can call us during the week at our corporate headquarters. But we're going to look at some of the emails, and I think you'll find it interesting, because I think you'll find that it's not really just a cut and dry yes or no answer very often. And of course, I'm joined in studio with Chris Fabian. Hey, Chris.
Hello, Esther.
Hello, Christopher. Okay, so we got emails here, and you take it away. And
yeah,
is there anything? Oh, by the way, I wanted to mention though, one of the major things that just happened is that there was a correction due to a revenue ruling in March and April that can affect a lot of people. Why don't we talk about that first?
Sure. It comes down to inheritance, basically, and where it's coming from. And so this one is if it's coming from a irrevocable trust. So what an irrevocable trust, some people are going, huh? And that's where you're taking your money and you're moving it from your tax ID number, which is your social, into a separate tax entity, which has a new tax ID number. And you're protecting those assets from a nursing home.
Right. That's usually why people do that, right? But the thing is, what people don't understand is a trust is like another person.
Right.
You literally have given your money to that other person so that it's out of your name so that you can take advantage of some loopholes.
Right.
But not so much anymore.
Correct. So now when that person dies who put the money in that trust, people think, oh, I get a stepped-up basis. Mom died. No, because it's in an irrevocable trust. It goes back to mom's basis.
And the thing is, they can't even fix it now.
No.
I mean, let's say that 3 years ago, you placed your family home in an irrevocable trust. And now they've just come up with this revenue ruling that says, too bad, upon the death of the person that had the house, that is just going to be in the trust, and it's basically like it was a gift to the trust, so it goes back to the donor's original basis plus any improvements. So that's a great big change.
It is. So you really got to sit
a negative change.
Yep, got to sit down with your elder care lawyer and figure everything out to make sure.
And as far as I can see, there's just no way to get out of it if it's an irrevocable trust.
Yeah, well...
can the trust gift to somebody?
Well, you can break an irrevocable trust if all parties involved agree, I remember.
But we have Jeff Katz coming on in the next few weeks, don't we?
Yes.
So that's he is an elder care attorney, and if you're somebody that has an irrevocable trust and you need somebody to talk to, Jeffrey Katz would be a great person to talk to, or your own trust attorney that set it up, so that you want to make sure that on this side of heaven you've done everything you can.
Yes.
All right, Chris, we have some questions here.
We do. EG Tax. My husband and I have just moved to Florida. His business is still here in Western New York. We are renting in Florida until we can find a house. Since we have no home in New York, we have rented him a small apartment. He spends 3 days a week there. Can we take the expenses for the apartment and the airfare? Sunny.
Well, here's the thing. Where you earn your money is considered to be your tax home. So it sounds to me like now this is Sonny's, right?
Yes.
This gentleman's and his family have moved to Florida, but his income is derived in New York State. And so as a result, that is the expenses that he would incur for the apartment and the airfare, since his tax home is New York, would be non-deductible. Would you agree with that?
I would agree. Now, what he should almost consider, what type of business does he do, and can he do it in both places and make Florida his primary home?
Well, I think his primary residence is Florida.
Right. But I'm saying have
his
the
tax
business
home.
Right, but do the business in Florida and New York.
So remotely, right?
Right.
So it's where your actual body is located.
Yep.
So in this case, no.
And if they're thinking they're going to avoid New York taxes, they got to watch the days test too.
That's correct. And the other thing is, if he's spending any time in New York State making money and that business is in New York, he's got to file a New York return for the corporation there too.
Right.
If it's a corporation.
Yeah.
So no, if you are renting an apartment for your spouse working in New York State and you're living in Florida, that's just an extra burden that you're going to have to bear.
Right. I mean, even if it was a part-time thing he did up here, and he was a Florida resident, he would still have to file a non-resident New York return for the income earned in New York.
Right, but he's still not going to be able to take the
He
the
still
apartment.
wouldn't be able to. Right.
Right,
Yep.
absolutely.
Yep.
Okay. All right, and what else we got here?
We got listen faithfully. Thanks for your insight. I now have a problem. I just inherited my father's IRA worth $25,000. They say I have to take the withdrawals over 10 years, but I would like to pay off my credit card debt with the money. Since I'm under 59 and a half, will I get penalized for taking more than the annual amount?
Okay, so this is a pretty clear-cut thing. I mean, when you inherit an IRA or a pension, your age doesn't have anything to do with it. You can take the money out if you're under the age of 59 and a half without a penalty.
Right.
However, the $25,000 is fully taxable if you decide to take the whole thing. You don't have to spread it out over 10 years.
Right. You have the option to take it over 10 years. You can take it as much as you want up front, and so here, I mean, he really should take $20,000 out now, because as long as he's the only beneficiary, he would pay no tax to New York. He would
New
only
York State.
Yeah. He would only pay
Right.
tax to the feds.
Right, as far as the state return, but on the federal return, he's going to have. Now, here's the other thing that this person has to think about is maybe you have the option of putting money away in your pension plan at work, and maybe up to this time you haven't been able to because you had those credit cards. But once you pay off those credit cards, maybe you can start loading up your pension at work, which would then reduce your taxable income on the federal for your wages, and it would mitigate a little of that $25,000 that you're taking out from your father's IRA.
Right. I know. I just had somebody come in the office this week, and his wife just passed away, and his financial broker's like, well, just take out all the money. You're going to have to
no.
anyways. And I said, well, how much are we talking about? And he goes, $200,000.
Oh, my gosh.
I said, well, you want to lose 35% of it? He goes, what? I
Yep.
said, well, that's what it's going to cost you if you were to take it out all now. Just
And that's because the number's so big, the
Right.
200,000. But in this case, with our questioner, this is not so much money, and you can still move around some other things, like putting money into that pension plan, putting money in an IRA to help mitigate the taxes, but there will be no penalty.
Right.
Right.
And you got to, call us, make plans before you do anything.
That's right. That's right. All right, I'm Esther Gullius, the tax lady from EG Tax. We're not taking live phone calls today. We're just chewing up your emails. We're going to take a short break. We'll be back on the other side. Hi, I'm Esther Gullius, the tax lady from EG Tax. Thanks for listening. This is Ask the Tax Lady. Today we're not taking live phone-in calls. We're just chewing up your emails. We talked before the break about the big change if you have a irrevocable trust. Those of you that have had irrevocable trusts, and if you do and you have put your house into the trust and you pass away at that point in time and the trust is in full force, you do not get the stepped-up basis anymore. So that's really a big thing for inherited property. So there are ways around it. We can talk about that too. But we're here with your emails and your texts. And Chris, we have what else we got here?
Okay, this one's appropriate for this time of year. My husband and I are cleaning out our house and debating whether we should have a garage sale or donate all our stuff to charity. If we have a garage sale, is the money taxable? My husband wants to take Venmo as payments. But if we donate it, don't we get to write it off on our tax return? How much would it save us? Sue.
Okay, well, this is such a classic problem that people think. You know, the standard deduction, in order to itemize, and that's where the charitable contributions would lie, except for the small adjustment on page 1. That's where the itemized deductions would lie. You have to meet that total and exceed it in order to get any benefit for giving money to charity. Now, that doesn't mean that you won't, but you're going to find out that, for instance, if you're a married couple, the standard deduction is like $27,000. So when you take your medical, your property taxes, your mortgage interest, your charity, and add it together, if it doesn't come over $27,000 and you've given this money to charity, these items to charity, you're not going to get any benefit for it. You might get a small benefit on New York State because New York State will let you itemize. But on the federal, probably no dice. So when you have a garage sale, generally speaking, you're selling your own stuff that you paid more for at a loss. And a loss on personal items is not deductible. A gain is taxable, but when you're selling it below fair market value, it's not going to cost you anything. So the short answer is, I would have the garage sale because you get real money that is going to be not taxable. Now, let me throw a monkey wrench into this. Let's say that they want to have a garage sale, but they've picked up some stuff over the years that, or maybe went around the neighborhood and you know, another man's trash, another man's treasure, and they're going to sell something that they have a zero basis. That's different, right?
Right. So that's a gain, and you would have to pay tax and self-employment tax on it because it's considered a business now. And
now, what if her husband takes the Venmo that he was talking about?
Well, that's the new thing this year is the Venmo reporting of sales over, not just sales, but any Venmo transactions totaling over $600. You'll get a 1099-K this year. And so then that comes to reporting it on your tax return. It doesn't mean it's all going to be taxable because it's going to be up to you to break down how much was a business and how much was personal.
But if the whole thing, let's say this really is all their old junk, chairs, tables, lamps, ugly pictures, and over the years they've accumulated them, and they actually paid for it, and they're selling them at a loss. How do you handle that on the 1099-K?
Yeah, that's the fun thing. The IRS hasn't even come out with the 1040 yet to show how this is going to work, but we believe there's going to be a line that says 1099-K reported personal money from that 1099-K, so then you only get taxed on the difference. And then it's going to be up to you to prove it in an audit that the amount that you said was non-taxable.
And it's always a good thing to be audit-wise because in the event of an audit, you have to prove what you put on your tax return. And so it's a good idea to make a list of everything that you have at the garage sale and maybe how it was used personally, you know, because that would establish that there was no gain. Right. You know, so this is going to be an interesting thing, the 1099-Ks this year.
Oh, it's going to be so much fun because I know there's a lot of people who do it. You know, you go out to dinner with your friends and one person puts it on their credit card and the others people say, oh, I'll just Venmo you the money.
Right. I mean, not a good idea.
You know, so start splitting the bill at the restaurant again. The waitress may not like it, but...
Okay, what else we got here?
Okay. I'm trying to make wise decisions for our future. My wife and I are in our young 70s, and we are worrying about nursing home costs. If it becomes a reality, we have substantial assets. Our home is worth $300,000, pensions and retirements of $900,000, and investments worth another $400,000. We have no long-term care insurance. We have 4 children as well. What do you suggest?
Well, they have a lot of assets, just like this person said. So they have $1.6 million in assets. But here's the thing: nursing homes run
Almost
like
$170,000 a year right now.
A year, right. So the important thing is, if they are in good health and they have a 5-year window, what they might want to do is, first of all, put that home not in an irrevocable trust, but put it in a life estate.
Right.
Because then that stepped up basis, because they might have paid $100,000 for the house, and now we're $300,000. So if their kids inherited it, they're going to pay taxes on $200,000. But if they put it in a life estate, that's a good thing for them, because they're not going to have to. The kids won't have to pay taxes on it, and they will get the stepped up basis, because that wasn't precluded in that revenue ruling. When they were talking about irrevocable trust. So that'd be the first piece. The second piece, pensions and retirement, you really can't gift that away right now, right? I mean, because if you were to give it away to your kids, you got to pay taxes on it.
Right, yep.
So that's kind of not a good idea. And then the investments, they could gift that away to their kids right now.
Right.
And at least eliminate $700,000 of the assets, leaving just the pensions and retirement on the hook.
Right. And the thing is, with the gifting people, how can they gift that much away? Well, if these people are in their 70s, their kids are probably 30s and older. Hopefully they're married. You never know. But if they are, they could give $136,000 a year and not file a gift tax return.
That's right. And if they did this consistently
in 3 years,
right. So they would. Now then, the other thing is that 5-year look back window, because if you're looking to get on Medicaid for the nursing home, they're going to look back at your the gifts that you gave over that 5-year period. So you want to keep your fingers crossed if you're looking to go into a Medicaid assisted nursing home. But they still have a lot of other assets, so they are still going to be at risk unless they start withdrawing some of that money, and they're going to pay a lot of taxes on it.
Right, depending on what their other income is as well, what their investments are earning and stuff like that. But proper planning could avoid a lot of it. So. Right.
So you figure on $700,000 you take out of the fire. Which is a lot because rather than you have your $1.4 million, but when you take a look at a husband and wife, could be $300,000 a year if they're both in a nursing home. It doesn't. Yeah. It takes 5 years and your money's gone.
Yep, for sure.
So you got to do it now.
Yes.
Right.
Correct.
Okay. What else we got?
Sarah writes in, my husband and I are remodeling our kitchen and bath. Estimated cost is $40,000. We have savings of around $10,000, so we're thinking of taking the rest out of our 403B accounts. We want to be debt-free when we retire in 5 years at age 60. What amount should we have withheld from the $30,000 to pay our taxes now?
Okay, you got all that figures written down?
Well, it means they're like 55.
Right.
So if they take the money out of their 403B, there's a 10% penalty.
Right, which is not a good idea.
Right, but wait.
Plus their taxable income.
Right. So they're in the 22, 24% bracket. So 22, we'll say 22, plus the 10, that's 32%. Plus New York State, you're looking another 7%. Right. So you're looking about 40%.
On that money.
But they're still working. This is a 403B. Why not borrow the money?
And that's exactly right. And that's what people don't understand, is that borrowed money is tax-free. And you can go to your employer and say, we need to borrow money against ourselves, and you have a 5-year period to pay yourself back, and it's going to be tax-free. So how much money did they say they wanted?
They need $30,000 more.
$30,000. So at 40%, it would cost them $12,000 in taxes.
Right. So they would
which
actually
they would save.
They would actually almost have to take out then $45,000.
Right.
Which to give them the 30.
Right. So it's much better to do a loan against yourself than you pay yourself back and you go to your employer and they're the ones that will let you kind of rob Peter to pay Paul, and then you pay yourself back.
Right. And maybe they're charging you 9% right now, and a home equity is 8% or 7.5%, but you're paying yourself the 9%.
That's exactly right. That's exactly.
Nobody's making. You're making the money off of it.
Right. And you're still whole at the end.
Right.
All right, I'm Esther Gullius, the tax lady from EG Tax. If you need the best tax help, give us a call anytime, Monday through Friday. You can go to our website at egtax.com. We're going to take a short break for the news, and we'll be back on the other side. Hi, this is Esther Gullius, the tax lady from EG Tax. I hope you're having a wonderful July day. I know this time of year in Western New York is like a holy time of year because everybody remembers the winters, So we're talking today, we're chewing up emails and texts that you've sent in, and I think you'll find it interesting. So don't call, not today. Next Saturday we'll be taking live phone calls again. During the week, of course, you can always go to our website at egtax.com, ask the tax lady. I'll be very happy to answer your tax questions. Sometimes what I'll do when I answer those tax questions, I'll say, we need to talk to you further because it's just not easy. It's not cut and dry when you're presented a tax issue, because if you do one thing, it could do something A. If you do another, it can be B, and sometimes B might be better than A, and it all depends what you're doing. So we like to talk to you many times. So if I refer you back to the office, it's because it's pretty complex. But okay, and I got Chris Fabian with me, and we're chewing up emails.
Right.
What else we got, Chris?
Well, I want to say too is if you're getting letters from IRS, New York State, any other tax authority, don't just pay it. Have us review it. We do that at no charge. It could save you a lot of money because I'd say 70% of these letters are incorrect in their figures.
And then worse yet, yesterday, I got a text. I got an email from the Internal Revenue Service stating that they want to check my identity to make sure that the tax return I sent in was correct, and that they're holding a $973 refund. I looked at that thing, and it was really good. I mean, it looked just like an IRS correspondence. There was no name on it. Right? I mean, it didn't say Esther Gullius. It just said, it said taxpayer. Call us. We need to verify your information. The interesting thing is I was thinking of calling them, and then I realized the IRS sends it through the mail. They don't email you. And it was a scam. First of all, I have an extension, so I'm doing my tax return in October. And I don't have a refund. But it was interesting how legitimate it looked.
Right. You got to be. Those emails right now are unbelievable how they look, and you got to be so careful.
So again, if you have a tax question, you're getting letters. Remember, the IRS first point of contact is through the mail.
Right.
Okay, and I know that, but when I opened up my email, I thought, oh my gosh, they're writing me. But so the stuff through the email and text is unbelievable. You can call us, and we will give you a second opinion. You can come down and have us see what you're seeing on your cell phone. But and we will help you. Don't just react.
Yep. And then also, if you want to think like us. I know that would be scary. Our tax school is starting soon. End of September.
In the fall.
Yep. Give us a call. We got early bird specials, 2 for 1. You and a friend can take the course together for one cost. You can't beat that. I know.
And it's fun. And it's fun to have a friend that's that's taking the course with you, because you might understand something better than them, or they better than you, and you can collaborate and do your homework together, and it makes it a lot of fun.
And I believe that's how you got started. You were the friend.
That's true. My sister-in-law said to me, "Will you take a tax course with me?" And I said, I'm not even remotely interested in taking the tax course. And the rest is history.
Yes. Okay.
All right, what do we got?
Well,
Chris?
speaking of a scam, I was involved in a scam last year where this man called me and said there was a lien on my home, and ordered me to leave. I don't know what to do, and he offered me a way to pay to get the lien released. Millie said that then he said $30,000 would cover the lien and it would take care of it for me. He seemed to really care about my home, so I took I took the money out of my bank and paid him. When I told my daughter about it, she contacted her lawyer, who said it was just a scam. I had no idea how to get a hold of this man again, and now I'm out the money. Is there any way I can get some tax deduction for this? I paid him in 2023, direct deposited it into a credit card.
Isn't that so sad?
Yep.
So sad. Well, there is casualty and theft loss, right?
Right. Well, a theft loss now. Casualty has to be in a natural.
But I mean, but that's together, it's casualty and theft loss. So Millie then would have a bona fide theft loss. What Millie needs to do, though, is she needs to go to the police and file a report so that they can do whatever the police will do, so you have proof that you received a scam and you're out the money. And with $30,000, even with the floor, she ought to be able to itemize, one would assume.
Right. Yep. Yeah.
So, gee, I feel so bad for her.
Oh, yeah.
But that's where we come in. When somebody calls you and it just doesn't seem to make sense, she probably knew that her house was paid for. How could she have a lien? Call us.
Yep.
We don't charge for at least, because, remember the lady that had the Walmart charge cards that came in and she had gotten scammed, and she... I think you were sitting down with her and you called the FBI and everything. We want to help you. We want to be your friend, and we will make it easy for you. But before you pay anybody, including bills from the IRS and the state of New York, give us a call. We are happy to help.
Right.
For no charge.
Yeah, and if somebody's calling you asking you for money, don't be afraid to say, "Let me call my lawyer first. What's your number where both of us can call you back at?"
Right.
And see what they say. Because if they just hang up...
They'll hang up.
Yeah, it's a scam.
Yep.
It's...
Although, in this fake letter that I got from the Internal Revenue Service, they had a phone number call.
Yeah.
And some of those phone numbers, those people, you've heard it. I think the news did an article about 4 or 5 years ago, and while they were in my office doing an interview about the scams, the IRS fake phone calls, we got a fake phone call. And we recorded it. And so it was very interesting, because when we said, you're on local television right now with this phone call, they went off ballistically and swore at us and hung up.
Yep.
Right?
Yep.
It's so sad that there are people who, if they could just get a real job, maybe they'd make money instead of trying to rip people off.
Yeah, I always say if they could only use their powers for good, what kind of world would we be in?
Yep, that's for sure.
Yep.
Okay, what else we got, Chris?
Okay, this is an interesting...
I feel so bad for that Millie. Okay.
I know. Esther and gang. My son does online sports betting. Oh. And what he told me is that he's up about $5,000 this year. The issue is he is only 16. What do we do come tax time?
Okay.
Well, there's a couple things here that stand out.
There's a lot of things here.
Right.
So you take yours, and then I'll pick it up where you leave off.
Okay. Well, he's only 16. How old? You have to be at least 18 years old to have an account. So Dad don't be surprised if you're the one who gets the reporting and you have to report it on your tax return. You know, because obviously he's used somebody else's date of birth and social security number to create this account. Other than that, if he did use his own name and social, he's going to have to file a tax return. And this is considered unearned income, so he's going to have to pay kitty tax. And
if they claim him.
If they claim him,
right.
And your son is going to have to use your tax return to figure out his taxes.
So when you take a look at this, the first thing that the child, because the kid's under the age of 17, he would save the parents $2,000 in taxes because of the child tax credit. So it's not like you don't want to claim them. And so even if he has to pay taxes at a kitty tax rate, it still would be much less than the $2,000 credit that the parents got, right?
Right.
So, but kitty tax is a way for, if it's unearned income, and believe me, gambling is unearned income, that the Internal Revenue Service came up with, that parents were shifting income to their children in a lower tax bracket, and so that's why they came up with this thing called kitty tax. So if you claim the kid, then you'll get the $2,000 credit. They're going to have to pay taxes. Now, maybe Junior is going to keep making money. What if he's ahead of the game, $25,000, $30,000?
Then you got to look at not claiming him.
Right.
I mean, because first of all, what did he do with the money? Did he pull it out, and did he use it on his own? Did he support himself? Because you have to provide proof that you supported him more than he supported himself.
Right.
So you may
to
not
claim him as a dependent.
Right. You may not be able to claim him. But at that kind of money, the kitty tax would probably just destroy.
And the kitty tax would go away.
Yep.
Because if he wasn't claimed on the parent's return and he claims himself, then the kitty tax is going to go away and he'll get the higher standard deduction. So he might have to pay $1,400-$1,500 in taxes. So that's not so bad.
Right. Yep.
After the standard deduction is applied.
Yeah, and that's going to be another thing this year. I mean, this is a big industry. I mean, I forgot what the report is, how much money New York State has made off of these online betting aids, like DraftKings and all these other places.
I have never, I think I went into a casino like 3 times, and it was like a vacuum cleaner came and sucked out all the money in my pocket, and I thought, no, I worked too hard to do this. But I know that's for some seniors, and it's especially important for seniors that you have to understand that all your winnings are included as your income. The expense that the loss is an itemized deductions, and many of you can't itemize. So you're just stuck paying taxes on the winnings that you really didn't win because you put the money back in the machine and lost it. So you got to be really careful. And it makes your Social Security higher taxable.
Your Medicare. Yeah, it makes
and
more
your Medicare, too.
Yeah, it makes more of your Social Security taxable, and you pay more for your Medicare.
Right.
So
absolutely. I mean, the seniors should just stay out of the casinos.
I know.
Really?
I know. I've had some clients I tell, just don't bet where you win the jackpots. And but that's not fun. I like winning the jackpots. Well, then don't complain about paying taxes.
That's true. And it can just be when you think about the taxability of the Social Security and the increase in your Medicare, it's just not worth it.
Yep.
So you would never want to throw that money away, and really that's what happens.
Yes.
Okay, so we're ready for our break, right, Mr. Chris?
That's correct.
All right, I'm Esther Gillies, the tax lady from EG Tax. We're just chewing up emails today. We're going to take a short break. We'll be back on the other side. Hi, I'm Esther Gillies, the tax lady from EG Tax, and we hope you're having a glorious summer. I know we are. We're talking emails today and texts, and I got Chris Fabian with me. So, Christopher, what else we got? What other emails we got here?
Okay, let's see. I have a small business, and thankfully it's profitable, but I don't have a pension plan. I'm a sole proprietor, and my net profit is around $75,000. So I pay a lot of taxes.
He does.
I want a pension. I have no employees. and I also want to cut my taxes. Any help? Julian.
Okay, so first of all, I don't know if people understand what self-employment taxes are. Why don't you explain what that is, Chris?
Sure. It's self-employment taxes is you paying into Social Security and Medicare. So just like your paycheck where you pay, there's that deduction out of your paycheck. But a self-employed person doesn't get a paycheck, so they get hit on their tax return with the self-employment tax, which is 7.65% twice. So 15.3% because they have to pay the employee's share that a normal person sees out of their paycheck, but they also then have to pay the employer's share, which no one sees out of their paycheck. But the self-employed person has to pay that. So that's 15.3% of the net profit. So 75.
So in his situation, it'd be over $11,000.
Yeah.
In just FICA.
Yep.
And Medicare.
Yep.
So that's why he was complaining. Now, he was talking about a pension plan. The interesting thing is he could set up a solo 401k plan.
Right.
And so in that situation, he can put away, I think, $53,000 into a pension plan. Obviously, it would leave him with not much to live on because he still has to pay his $11,000 in taxes because you don't get rid of the FICA by putting in a pension. But it gives you a lot of latitude. So if he set up a solo 401k, he could put in, and it's kind of an elective deferral, he could put in $10,000, $15,000, $20,000, and then do a match on himself and start really building up his pension plan. Now, the good thing is, even though it doesn't reduce FICA, it does reduce your income tax liability, though.
Right. So his income tax would be next to nothing if he maxed it out. But like you said.
Now, like for instance, what if he did he put that money into into a solo 401k plan, and he didn't pay any taxes. The only thing he would owe is FICA and Medicare then, right?
Right.
And on the state of New York, nothing.
Correct. Or next to nothing.
Right.
But, yeah.
So that's one thing you can do. Now, the other thing you can do is you can buy machinery and equipment for your business. That's another way of reducing your overall tax liability. And that will also, now the difference is with machinery and equipment or any business expenses, that does reduce both your FICA, Medicare, and income tax.
Right. And I see a lot of people forget their car expense. They forget their mileage because they don't realize they can write off their mileage as
if you're self-employed. Right. But what I'd suggest that Julian do is come in and let's take a look at your tax return and show you, just like if you put some money in this pot here, it's going to save you income tax. If you put money over here, it's a pension, and it's going to save you income tax, but it's good for your future. If you do some upgrades with equipment like new computers and things of that nature, we can do a 179 or a first year depreciation expense and write off all that. That'll save you both FICA and income tax. So it really requires you to do a plan and not just a shot in the dark.
Right.
Definitely. Okay, what else we got here?
Amy writes in, I am a single mom with one daughter. She's starting college in the fall. Do I still get to claim her, or should I change my withholdings from my job? I don't like surprises on my tax return.
Well, that's a good thing. That's true. So up till age 24, if your child is a full-time college student, up till age 24, regardless of what the money that the child makes, the parent can still claim them provided they're giving over 50% of their total support. So in this case, she'd be able to claim her daughter and the education credit, which is so important because she'd get the American Opportunity Tax Credit on the federal, and on the state of New York, she'd get the New York State Empire the college credit. So that's a lot of money that the mother has coming back.
And she possibly, depending on her income, the earned income credit.
Right, correct.
So, yeah.
And so if she gives up her daughter, right?
Yeah.
She gives up the federal credit, the state credit, and if her income is low enough, the earned income credit. So it's not a good thing not to claim your daughter. Even if your daughter says, but Mom, everybody in the student union says that they're claiming themselves. Don't do it. You're better off giving your daughter $1,000 out of your refund to be able to claim these things, because it's very important. And the other thing that's available this year, they've increased the pension savers credit. So that's another credit that she might get. So
Yep.
all in all, the parent of a college student should not give up that right to claim the college student.
Yes, for sure.
Right?
Correct.
Okay.
Okay. Paul writes in, Tax Lady, I'm thinking of having solar installed in my house. We are seniors on a fixed budget, and the way the salesperson showed us, even with us borrowing a lot of the cost, we will save nearly half in taxes. Our electric bill runs about $175 per month, so that's nearly $2,000 annual savings.
I'm not going to tell Paul how bad of a decision this is probably. Right?
Right.
Because if Paul has no taxable income, this credit that the salesperson for the solar company is telling them is just pie in the sky. It's not going to happen.
Right. Right. You got to have taxes to get the credit.
Right. But here's the thing. Thank God it's the middle of the year. It's July. And we still have 6 months to affect some income. So let's say that Paul and his wife have very little income. Maybe they're living on Social Security, but they have $200,000 tucked away in an IRA. It might be in their best interest, because let's say the credit is $15,000. It might be in their best interest to take money out of their IRA, which would then be taxable, and then they'd have the non-refundable credit from the solar to offset the taxes, and the money they can then just put into another form of investment, and they never have to pay taxes on it again.
Right. Right. So,
But if Paul doesn't know that, and Paul goes ahead and does the solar, and his income is mostly from Social Security, and they pay no taxes, then poor Paul and his wife are going to get no benefit, and the only one that's laughing to the bank is the solar company.
yes, for sure. For sure.
So it's always important, if you're making a big financial decision, and they're telling you that there's a tax benefit to this decision, call us. We'll tell you all the ins and outs. That's why many times when people are saying, oh, you should put money into a Roth, put it into a Roth, they don't even take into consideration, is there any other source of income that this person has? You know, and because it isn't clear cut like that. There's so many if and ors or buts, and if you don't take that into consideration, what you think you're doing is saving money, it's actually costing you money.
Yep. Yeah. Plan.
Right. And call us.
Exactly.
Right.
Okay. Stan writes in, Esther, my mom tells me that her friends got refunds from New York State last year, and she is wondering why she didn't. I told her she's only on Social Security and doesn't need to file. She said, so are her friends, Betty and Jane, but they got $350. How is that possible?
I know what that is.
Yep. What is that?
So that's the property tax credit on the state of New York. So they didn't get income taxes. They got a New York State refund of their property taxes, because their property taxes, compared to their tax adjusted gross income, is fairly substantial. And so they got back a portion of their property taxes. And if she didn't file that form, then she should try and see if she qualifies, because she might have $350 coming back as well.
Right. Not just for 2022, but 2021 as well. As long as mom is a homeowner, she could qualify.
Right. So, and it's not too late.
Right.
To fix to 2021 or 2022.
Yep.
So that might be the mystery of the $350. Okay, we got anything else here?
Sure. Jose, Esther, we just retired and bought a motorhome in the U.S. To see the USA. The salesman said we should be able to use this on our tax return. My question to you is, how?
That's what I'd like to know.
Well,
I'm going to tell you, all there is the sales tax. That's it.
Well, if it's considered a second
and it's
home,
mortgage interest,
there could be mortgage, but you would have to be able to itemize, and that's where tax planning comes into play. Just like the solar panels, if you have no taxes,
you get no benefit.
Yep.
Or if you can't itemize, you get no benefit. So it's so sad. You listen to these salespeople who are giving you tax tips. You should call us because we are the ones that should give you the tax tips. Right?
Yep.
Well, anyway, this was an interesting show. I love talking about unique situations. If during the week you have any questions, or you get letters, or somebody's scamming you, or you think you're getting scammed, give EG Tax a call. Our corporate headquarters is on Colvin Boulevard in Tonawanda. Our branch offices are closed this time of year, but we're there Monday through Friday, 9 to 5, and if you need special evening appointments, we're open as well. So until next week, I'm Esther Gulias with Christopher Fabian. Thank you for listening, and thank you for your input, and we'll talk to you next week.